Hello my fellow freedom builders, and welcome back to the channel and to a video that I have been looking forward to making for the last several weeks. If you have been following my channel, you know that I put videos up almost every single day, and for the last weeks or maybe even months I have simply lost track of time here. It has all been about electrical vehicles. It has been about hyped stocks without any solid fundamentals. It has been about the virus, the crisis, everything in that part. But today I'm gonna make one of the videos that I used to make and that I am planning to make on a regular basis again, and that is rock solid stocks. Meaning stocks that actually have a decent pricing compared to the fundamentals, and where we can see some good solid trending earnings and cash flow and so on. And I'm going to tell you today how I find them, and we're going to have a look at 4 or 5 of them today, both from the FastGraph software and from Stockopedia. And we're not going to look so much on graphs today, because that is not really what this is about. This is about finding the candidates that we then later on can try to time. All right. So I also, should I say, have a single stock in here today that might not be so solid, but a lot of you have asked me, since I made a video about it a long time ago where I was not that thrilled about it, and many of you have asked how I feel about it today. So if you want to see what interesting stock that is, you can just stick to the end. By the way, I know that videos like these are not as popular as they're not going viral like some of these EV hype stocks or videos almost do. So please, if you would help the YouTube algorithm just figuring out that this is also interesting, you could hit that subscribe and the like button down there and the bell notification and all that stuff. That would really help both me and YouTube. All right, let's get right to it. If you remember from far back, I am using this FastGraph software, and I'm still using this on a daily basis, even though I haven't been showing it too much in the videos. But in here, I can put up a screener here. I can build a screener. I should say that I'm not affiliated with FastGraphs. They're not interested in that sort of deals. That is okay, but I do recommend the software anyway. This is the paid version, the expensive version, you could say. It's actually not that expensive, but it is the highest price they have, because then I get access to the screener. What I'm looking for here is an S&P credit rating of A- and up. As you know, this go from the worst of the worst and then up to AAA, and I'm going for A- and up, meaning that in here I actually kind of make sure that all the clever analysts, they have been looking at these stocks, and they have agreed that this is a fairly solid company. Then I'm looking at the United States shares only. I want a PE ratio between 5 and 20, and I have explained that in other videos, but that is because often below 5 we often get a lot of stocks that have dropped too much for a reason. So I'm looking for 5 and up to 20. We could put it above 20. That would of course give us some more candidates, but I want some good solid earnings yield on my stock. I'm going for earnings per share yield of 7% and up. I'm going for free cash flow of 3% and up. I'm going off at a market cap at 5 billion and up, and I know it is a bit squeezed together here. I'm sorry about that. When I'm recording here, I need to squeeze it a bit. But long-term debt to capital at a max 50%, meaning that they actually have they're not over leveraged. So that is one of the things here. Then there's the historic numbers. I want over the last 3 years, I want an earnings per share growth of 5% and upwards. I want a free cash flow earnings of 5% and upwards, and for the estimates, I'm going for an estimated growth in earnings per share of at least 3%. So that is the basis of my scan here, and I'm getting a number of candidates, 15 to be certain, out of 22,000. So I am quite picky here, and let's see what I have found. Out of these 15, I have removed a lot of them, and that is simply the ones with the earnings that are too choppy. I want straight lines, and let me show you what I mean here. For instance, we have the Cigna company, and I'm not going to go into depth with each single company. I'm just going to show you why I have picked these, and then I will do all of the in-depth analysis afterwards, and you can do that for yourself as well. This is not buy or sell signals in any way. This is simply just inspiration and some teaching about how I find my candidates. Now, what I do when I buy some of these candidates, and it's not even certain that I buy one of these, but if I do, then it is for the long hold. This is for my portfolio where I really keep it for several years. I do have a portfolio like that. And if you remember, I made a video where I talked about covered calls, and that is often something I use on these stocks. So for instance, if you haven't seen one of these videos before, what this shows is the black line is the price graph of the stock here. The blue line here is the normal PE ratio, and the orange or brown here is growth in earnings. So what we're looking at here is that if we can find stocks that tend to oscillate up and down, over and under at least one of these lines, then we can get a feeling of when it is overbought or oversold, when it is value and when it is not value. And for instance, if you had bought somewhere down here in the green territory with Cigna from 2012 and up to 14, you could be pretty certain that you would have made a profit, because in the long run, at least with these sorts of stocks, the price tends to move towards what the fundamentals say it is worth. So here we saw it move up towards some fair value, and it moved above. And as you can see, when you buy above here, of course there are stocks, some Amazon and different stocks where it can be up here for several years, and that is of course too bad if we don't get in on them. But what you can see here is that if you had bought here in 2015 at a highest point in the overvalued, here 5 years later you would pretty much not have made any money, from 162 to 177 in 5 years. But every time you buy it down here in the green area, in the dark green area, there's a much better chance that you over 3 to 5 to 7 years will make a decent amount of money. Now what I do then is that when I have these stocks, I sell covered calls on them. If you don't know what that is, look up my videos about options trading. I do have a playlist in here on the channel with options videos that is fairly simple and something that can add to my earnings, and often do so. So we have the Cigna Corp here, and that is actually down here in the green zone. We are in a value area right now. What we do like to see here, and what I'm scanning for, is that we can see the earnings have gone up. That's actually the earnings up here. And we can also see that the estimates are going up. Now, in these times of crisis and virus and so on, the estimates might be changed over time. But for instance, here we have one, if we look at the forecasting here, that even though that they are predicting up here somewhere in growth, then even if it only kept here at a price earning at around 10, and we kept it, let me see if I can mark that one. Alright, maybe I can. Okay, but at least here from a 177 and up until here, we would still get an annual return of 14%, including dividends, of course, if there's something of that. Up here, if it just grows a bit more up towards fair value, we will get an annual return of 35%. Plus, of course, if we sell some covered calls on it. So that is pretty much what I'm looking for. I'm looking for stocks that have been in a great growth. That, of course, there can be a single down year here. But basically, the overall picture should be up. We should be looking for some good value here, and we should be looking for further growth. And when I enter, then I'm looking for some technical analysis, but that is another part of it. Let's just have a look at the Stockopedia. We can see here's Cigna. We have a stock rank of 86. That's great. We love that to be above 70. I'll put a link to the Stockopedia below here. There's a 25% discount right now. If you use that link, you can see that the quality is not at 70. We would like to see it there, but the numbers here are fairly okay. The PEG ratio 0.6. We like that to be below 2, so that is great. We can see that the EV to EBITDA 8.6. That is great. Petrushki score at 6. That is okay. The earnings per share normalized. You can see the blue columns here. They are simply just going up in the right direction from left to right. We like to see that. Free cash flow. Let's just have a look at that one. That is a bit more choppy, but pointing in the right direction. That's great. There's no dividend here, so let's just see. I'm not sure why on several of the stocks I can see a working capital of 0, and that is of course not true. So there might have been some error in the system here, but we can see the net debt here has jumped, and as far as I recall, that was some acquisitions and stuff. But of course, we want to see that they have a fair interest cover. This is just on the low end, but as we saw, the long-term debt to if you look at here in my screener, where is it? Here, we're long-term debt to capital below 50%, so we know that that should be fairly okay. So Cigna is definitely a stock that I could go on and research on because it has all the fundamental rock-solid criteria. As you can see, it is a health service company. And right now, with the virus growing in the United States and so on, we should definitely look out for companies that are involved in, for instance, health insurance, because they can be hit if all of a sudden they have to pay out a lot to people that are hit by a virus. But that is something that we will go in more depth with if we choose to. That Cigna could be something we wanted to invest in. All right, let's get on to the next one. It'll get faster and faster since I don't have to explain the core concept. Another stock that I made a video about quite a while back was actually Bristol Myers Squibb here, BMY. And what you can see here is, I don't recall the exact date, but I think it was sometimes in the just up around New Year 1920 here. And I said that I actually like the stock, and it hasn't moved a lot since then. 5.5% on an annual basis. That is of course not a lot, but it has been fairly okay treated here by the crisis in the stock market. And what you can see is that the earnings have been growing, the estimates are growing here. So everything here actually looks fairly well, I must say. If we look at the forecasting, we can also see that if it just keeps on the track right now, we are looking at the 25% per annual per annum here. And if we look at over several years, if it goes up to something around fair value, we're looking at 36% per year. That is including dividends, but not including the covered calls if you sell something on that. Also here in the FastGraph, sometimes it is good to have a look at the analyst scorecard that shows if the stock tends to fulfill the analyst's expectations. And if it is yellow, it is just around their expectations, so that is great. And if it is green here with a plus, it outperforms the analyst expectations. So this is either fulfilling the expectations or beating them, and that of course gives us some insight into if the estimates here are valid, and it seems like they are. If you're looking at BMY here in the Stockopedia, we can see nice stock rank at 85, a great high number at quality and momentum, PEG ratio 0.2. That is, of course, the PEG ratio is the current price earning divided by estimated growth in earnings per share. And as you can see, the earnings per share is estimated to be 56%. So growth, so that of course makes the PEG ratio quite low. And EV to EBITDA, that is not amazing, but it is okay. We can see a fair return on capital, operating margin. There's a Petrosky score that is only 4, and we would have to dig into that and see if there's something that have been dragging that down. The bankruptcy risk, I'm not really concerned that Bristol Myers here will go bankrupt, but they have been taking on a lot of debt. We'll just look at that in a second because they have made some large acquisitions. The earnings per share has been down in 2019. That is not the best. Right now we're looking at trailing 12 month. That is, I'm not looking too much on that. You can see the TTM. But in 2020 and 21, it seems like it will be growing quite a lot. So we will keep an eye on that. You can see the free cash flow growing nicely. That they do pay a dividend, and it's actually quite a fair dividend, just around the 3%. Now, the dividend cover has been a bit too low. They have been hovering here 1.7, 1.5, 1.9, and then last year 1.2, and trailing 12 month only 0.4. But as you can see in 20 and let's see 21, up around 3 and 4 again if the estimates holds up. So we can work with that. Working capital is going up, but net debt has jumped extremely much, and that is because they have taken on a lot of debt due to some acquisitions. So interest coverage 4.5. It's actually not that bad considering how much debt they have been taking on. Sales growth 82%. We can see the analysts, 26 brokers are saying buy, almost up a strong buy. So that is actually fairly okay. If you don't know them, you can read more about them, but they are a biopharmaceutical company making a lot of interesting products. But that, of course, is also something you would go into debt with if you were to buy a stock like this and keep it for many, many years. All right, the next one, Anthem here. Again, a stock, it has been going sideways for the last couple of years, and that is the thing here that normally when I trade at least a part of my money, I am going for timing some stocks, and I'm not going for 2 years of debt capital here just going sideways. But then again, out here, you might not even have wanted to buy it because we want to buy it when it is down here in the value area, and it is there right now. And it has been hovering around these two lines for many years now, and right now we are at the lower end, so there is definitely some potential upwards movement here. And if we look at the forecast, we can also see that if the forecast holds up 13%, if it moves up towards fair value, there's some very decent earnings up there, 32%. And of course, if we move down, that's also interesting. If it performs worse and moves a bit lower into value territory, we can see a 4% annual return here. We can see a minus 6% per year if things goes quite bad here. So that is an okay cushion to the downside here, no doubt about that. If we look at it here, they don't have the best of the scores, but they do have 77 here, 75. In the momentum and 54 on the quality. PEG ratio is fair. EV to EBITDA is in a great spot here. Petrosky score at 6. We do like to see that. Earnings per share normalized. What's not to like there? It is just going up like drawn by a ruler. We can see that the free cash flow, let's just have that one, going up. Has been a bit chubby over some years, but is going up now. They are paying a dividend around 1.3%. You might say that is not extremely much, but they are growing the dividend at a fair percentage, and they have a nice dividend cover of above 5 and going up to 6.7 here on the estimates. So what I do like is that I do like to see this dividend cover high. If you want to say that this is a dividend play, you want to be in something that pays dividend. And also, sometimes this can be positive, but still the free cash flow is not covering the dividend. So I do like to see that the free cash flow number is also covering the dividends by a fair margin. And here it is 4 times the dividend. So they're not paying out all their money, all their free cash flow in dividends, and I do like that. Again, a company where the working capital for some reason is at 0 right now. That is obviously a mistake. The net debt is high, but staying fairly stable. We can see up here. Let's just see, interest coverage 9, that is absolutely to the fair side. Sales growth, that is okay. So that is actually pretty well, and we can see that the brokers are also up, getting close to strong buy here. So that is fairly well. If you don't know him, it is a what is called here a health benefits company. Company operates through three segments: commercial and specialty business, government business, and other. And you can read all about that. But that is all about the Medicaid and Medicare and all that stuff. And again, it is something that we just should read a bit of the small prints about, because there might be some issues here with the virus. All right, last stock here of the rock solids is Ameriprise Financial, and of course the name tells us what that makes. As you can see, have been going sideways pretty much since for 6 years or so, but right now they are down deep in value territory, and if they were to move to the upside here, there would be some very large benefits there. You can see the forecast if they're just staying on the path right now. We're talking about 7% per year, but should they move up towards fair value, we're talking some quite decent yearly returns. We could just have a quick look at the analyst scorecard and see that they have been pretty good at hitting the analyst expectation, except in 2016 here. So that is okay. It tells us that it is a good, the estimates pretty much hold up. All right. So what do we have here at the at the Ameriprise Financials? Some fair numbers, 97 in stock rank, that is very good. PEG ratio just to the high end. I do like 2 or something like that, but sometimes there are some there are some situations where 3 can be okay. EV to EBITDA is very low, so that is good. Operating margins, return on equity is outstanding. Petrosky score 7. Great earnings per share going up, free cash flow jumping quite a lot, and when free cash flow jumps like this, I know this is trailing 12 months, then there has been some changes in business or acquisitions or something like that, and we would have to look into that. The dividend is fair, 2.6%, growing on a nice pace, and they have a very nice dividend cover. We can also see that the free cash flow is covering the dividend. The dividend as well. Here, dividends per share. I think I made a mistake just a second ago and took the number down here. But of course, it is the dividend per share here that we should compare to the free cash flow. Let's see, working capital 0. That's a mistake. Net debt is fairly stable. And if we look down here, we can see that the interest cover is almost 21, means that how many times can they pay their interest with their earnings per share, and we do like to see that, because then they're not running into some liquidity problems due to interest payments. So we can see down here 16 brokers are saying buy, and that doesn't change much, and yes, we can read into the details here. Also, quite a solid company where we could actually make a decent income, even though it might stay down here. We could actually make a decent income just from the dividends and the covered calls writings, and then we could hope for the price to get closer to the fair value up here, because then we would make a killing. But again, remember, these are 2, 3, 4, 5 years plays, so that is more for the long-term retirement portfolio. All right, the last stock today, and the one that many of you have asked me about, is Disney. And as I said when I made the analysis, and I should say that analysis was made before all of this fuss about the illness spreading around the world. But at that point, my analysis was that I was actually not too comfortable with the price or with the stock. The price was simply too high up into a negative territory, and there was some downwards estimates. Now, these numbers have of course been crushed due to closing down, the shutdown of the Disney parks. Right now they are opening up again in Florida, which is the state that is the hardest hit state right now by the virus, and that of course is a political and that is a discussion not for this video, but there's no doubt that the price of Disney has been crushed due to all of this shutdown, and that was one of my points of critiques in the video, as far as I recall, is that quite a fair part of their revenue and their earnings come from these parks. I think it is about a third of their earnings that comes from the parks. And I had no idea that this was happening with the shutdown, but what I said was that that part is hard to accelerate. They do have their Disney Plus platform, and that can accelerate from 10,000 viewers to 1 million viewers without an enormous extra apparatus of people and stuff. But if you want to 10 double or 100 double your park earnings, your park revenue, then well, that is simply not possible, because you would have to have 10 times as many parks pretty much, or of Disneyland. So that is not really possible, and I had some other considerations about that. You can watch the video, just search for Disney here on the channel. But right now, as you can see, first of all, they had this drop, and even though they are projected to or estimated to have some rising earnings here, they're simply too far down there. If we're looking at the forecasting, as you can see, if they were to move down to some sort of fair value down here, somewhere in the next couple of years, we would still be losing 10, 15, 20% per year. And I have a hard time investing in something like this. I know that some people say, well, the Disney Plus is gaining a lot of traction now. People are sitting at home, but that is simply not enough. They are also losing money on several of their other online platforms or their streaming platforms. So that is not something that I see that can be saving the numbers here. If we are looking at them here, momentum, we have an overall stock rank at 36. PEG ratio is okay, fair, but we can see down here Petrusky at 4, and let's see if and already in 2019 the earnings per share started to dip. So that was before all of the troubles with the shutdown, and as you can see, we are not getting anywhere near to that level of 2018 somewhere in the near future. Free cash flow dropping like a rock, also in 2019 before all of the shutdown hassle. We can see that they are slicing their dividends pretty much in half. And that is, of course, to keep the dividend cover, but they keep it up around in a fair area here. So I do understand that, and I do respect the cutting down of dividends. That is actually what I like to see. I know many of you dividend investors out there are screaming and saying that's not what they promised, but I simply don't see any reason in taking the, you can see here in 18 they had $6.50 in free cash flow. They paid out 1.68 in dividends. That was fair. Then they had $1 in free cash flow and paid out $1.76, meaning that they would have even to borrow or to empty some of their treasury chests for money. And here free cash flow trading 12 month 20 cents, paying out dividends doesn't make sense. So of course the dividends has to be slashed. Then dividends investors are howling and screaming, but there's not really any reason, if you're a long-term investor, to demand of a company to pay out more than they have, because you are emptying the company for values and the money that they should grow with, and that doesn't make much sense if you ask me. Working capital in the negative, net debt going up like crazy. Interest coverage is fair, sales growth okay, earnings per share growth is dropping. We do have analysts saying buy up here, but that is almost a standard for the Disney corporation. So that was just the Disney business. That is not one of the rock solid stocks. These stocks I mentioned today is as I mentioned here, Cigna, it is Bristol Myers, it is Anthem, and it is Ameriprise Financial. It's not even sure that if we dive into these that we are interested in any of these, but these are the ones that came up on my screener as I mentioned in the beginning, and that's what I do. Normally, I actually get a lot more than 15 candidates. I can get 40, 50, 60. But the thing is right now, what I'm doing with the screener is that I'm making sure that we are having prices down here in value territory. And right now, we have in the last month seen prices shooting up extremely high like this, and the estimated growth dropping like this, meaning that we are having a lot of stocks hovering up here in extremely overvalued territory. So either the earnings needs to come up like crazy, or the prices need to come down before the stocks can be interesting in this sort of analysis. It doesn't mean that I can't buy hyped stocks and without earnings I'm in with a little position in Tesla and so on, but that is with a completely other strategy. I hope this made sense. Nice talking to you again about rock solid stocks. There'll be more of these in the near future. Take care of yourself and your money out there, and if you haven't done already, remember to subscribe and like the video. So for now, bye for now.